Hey guys, Mike here. So today we're going to answer all your questions and comments, and please feel free to help out. I'm definitely going to need your help with one of these questions for sure. So please feel free to put that in the comments if you have any expertise on this one particular question from one of the viewers. But it's jam-packed with all kinds of stuff about Nvidia and everything else. So as usual, let's just get right into it and knock this out. So first one says, what do you think about Nvidia going from a 2.4 billion float to a 24 billion float? As far as I know, that'll be the largest float of all, definitely the largest float, the Max 7. I think that should put a damper on the Nvidia volatility for sure. Any thoughts? And we have another question from Scott, which leads into this as well, where he's talking about the same thing, but he's like, with so many outstanding shares, it will slow their stock price down, meaning it won't rise as fast, right? Because that would make it, like, say they went to $320 per share, that will put it at an $8 trillion market cap. And I'll say this before I say anything else. Stock splits, guys, are bullish for stocks, okay? I mean, historically, and we've seen other ones do this. Walmart just went through it, right? Tesla went through a bunch of them, even though their stock splits hit during a crash, as I showed you. But you can see what the S&P returned, and you see these stock splits, and it's not even close, right? And so this is a good thing for many reasons. In one, I'm going to basically explain this, but I'm going to go into what they're talking about with these market caps and stuff, and it will slow down the price and everything. And so what they're talking about, when you go to Nvidia right now, they're sitting there with roughly 2.46 billion shares, right? So that's going to be multiplied by 10. If I go to a market cap calculator, and so here's 1,057, here's the shares outstanding, and then that's the market cap, right? So if I change this up, and I say, okay, I'm going to time this by 10, right? And we change this right here, you can see that'll give us, what is that, 24, I have to say this twice, 24 billion, right? 600 million. Did I say that right? Yeah. And then let's say the share price is $100, right? So same thing, because that's what it would be if it was $1,000 a day and 100 then, basically the same market cap. Well, let's say I change this to 300. All of a sudden you're like, whoa, $7.4 billion market cap. If I change it to 200, wow, almost $5 trillion market cap, okay? And so just compare that to make sense of this. You know, go to Apple, right? Apple is sitting there around 2.9 trillion. If we roll up to Microsoft, if I remember correctly, it's definitely over 3 trillion at this point in time. This has continued to go up and outperform Apple when it comes to the price and everything. But you can see right there, so that's a 3.1 trillion. Keep this in mind. This is the important thing to remember, guys. And before we continue, guys, please hit that thumbs up down there. It helps people find the video. I really appreciate that. And think about subscribing if you like these kind of videos. One, when it comes to stock splits, the reason why it's a bullish thing for stocks is because all of a sudden it's a mental thing, right? People see $1,000 share and they go, whew, can't do that, right? All of a sudden they come say it comes down to $100. Say that's the price. It's $1,000 the day before the stock split, right? Divide that by 10, it comes down to 100. And people go, oh, I can buy a bunch, right? And so then they'll get in. Okay, they'll start driving in, so it attracts more investors. The other thing it does is on the options market, it makes the options way cheaper to buy them. And then also, because you can accumulate 100 shares without as much capital, right? You can start selling covered calls, or if you want to sell cash secure puts, because when you sell that cash secure put, they're going to lock that money up, because if you get called on that, they need to make sure you had the money, right? And so all of a sudden you go from, I don't know, it's $1,000 a share for 100, so it's $100,000, right? You go from $100,000 to $10,000 in capital. You would need to do that. And so that's a big difference. Plus, I don't know if you bought any call options for Nvidia right now. They're extremely expensive. And so you'll see more people flooding and using the options, whether it's buying or selling. Okay, and I'm going through that really fast, so hopefully that makes sense. So that's a couple reasons, right? But there's no more value to it, right? I mean, there's nothing like if Jimmy's sitting next to me, you can't see him, but Jimmy's sitting next to me right here, and I'm sitting here, and we both have $1,000, and Jimmy buys it today, right? And he gets one share of Nvidia. And I wait till after the split, and it's $100, and I use $1,000, I get 10 shares. But on that 7th, June 7th, excuse me, when they do the split, Jimmy, he's going to have 10 shares too, because his one share split, right? They gave him, he said, here, Jimmy, here's 10 shares now, right? And he's going to look in his account, and it's going to say not $1,000 per share. It's going to say $100 is your average cost, right? So he has 10 shares now. And guess what I have? 10 shares, both worth $1,000. Doesn't matter. There's no value to it, okay? Just so you understand that. But it is a bullish thing, and you saw it at Walmart, Tesla, whenever they did it, if it wasn't crashing, I mean, the stock market would crash and be different, but you saw how fast it would run up when the market started to recover, right? And Nvidia, you look at the old stock splits, that's just the way it was. That's just the way it is. Reverse stock splits are a whole different thing. Those are the ones that are not bullish, okay? The other thing to remember about this right here is that, you know, when you talk about market caps, look, Guys, 2010, if you started mentioning $3 trillion market caps, people would have laughed at you, right? I mean, I don't even know what Apple's market cap was in 2010, but you saw how much that stock went up, right? And so again, is 4 trillion going to get hit? 5 trillion, 6 trillion? At some point in time, the stock market keeps going up. Yes, it's going to get hit. I mean, imagine if you talk to somebody who's old enough to be trading or anything in the 70s, and you have told them, hey, by 2020, there's going to be like multiple $2 trillion companies, $3 trillion companies. They probably would have said the same thing we're saying right now. There would never be a $5 trillion company, $6 trillion, whatever it is, you know. But if it keeps going up and people keep doing splits and stocks keep rising, it's going to happen, right? And so I'm just putting that out there, you know. So just FYI on that one. Now, next one says, hey, Mike, do you see what Jamie Dimon said about them limiting stock repurchases at current prices, which indicates he thinks his stocks are overvalued? Dropped 4.5%. He also sold the first time, I believe, ever recently. Wanted to get your thoughts on it. Look, I'm not going to argue with Jamie Dimon, right? He knows his company better than me. And here's a direct quote. I want to make it really clear, okay? We're not going to buy back a lot of stock at these prices. Buying back stock of a financial company greatly in excess of 2 times tangible book is a mistake. We aren't doing it. And when you look, you can see what he's talking about. I'll show you all this, right? So here is the total return. That's the stock price and all that good stuff, right? Way up there, okay? You go down here to price to sales ratio, not as high as it's been in the past sometimes, right? I mean, .com was higher, 2021 was higher, it looks like, but it's getting up there, all right? And then when you start to scroll down, he's talking about this, price to tangible book ratio. It's up where you see a lot of times it turns down, right? And so it's getting up to that level. So to me, it makes total sense. I understand what he's saying, right? And so if you want to buy the stock. But yeah, if I'm purchasing stock, why would he do this? Plus, a lot of people think is, and that's what we don't know. One, watch out to see if he retires this year. If this man retires in the next 12 months, that is not a good sign, okay? And I'll let you figure out the reason why on that. But again, it makes sense to me. I would say the same thing if I'm him. So, you know, again, do what you want to do with your valuations. But if the company ain't willing to buy it, you know, maybe you want to think twice too, or maybe there's a reason besides the tangible book value he's thinking about. So hopefully that helps out. Next one says, question for Saturday's video, housing prices in my area are going back up again. I haven't heard you talk much about the housing market lately. Could you give us an update on what is going on? Because the prices are just way too freaking high for people to afford with rates where they are at. It seems to me the only way to fix this is to have a recession. Looking forward to your thoughts. Thanks. Real quick on the housing market, there's not much to report, really. I mean, this right here is existing home sales. I mean, there's not a whole lot moving. I mean, you can see on this chart, and you see month over month, not really going good, okay? I mean, I know we have neighbors trying to sell their houses, and we're actually in a hot market, and they're sitting on the market longer than they have in quite a long time, right? But again, rates are high, prices are definitely high, and some areas actually going back up. When you look over here at existing home and family sales broken down, this is what's really tripping me out. The top line is for 1 million plus homes, right? They're worth 1 million or more. The bottom line is 250,000 to 500K, which is normal people's houses, right? The 1 million plus homes are far outselling the regular folks' homes. Isn't that crazy? But you can see what the norm is, and we're almost there. Really, I mean, we kind of are there, right? What you saw going on from 2013 to 2020 when it comes to the houses that are worth 250 to 500K. So that's kind of shocking when I saw that chart. But again, you know, rich folks are definitely buying the bigger homes, that's for sure, right? And then you got new family homes, okay? When you look at this one right here, you can see this is annual, right? Where we're at, it's going sideways, you know, but then when you look back, you kind of like going, wait a minute. Like, you look to the left. I mean, that was kind of the norm where we're at, right? And again, these decreased, none of the numbers are coming in good. But I'll tell you the one that really makes me kind of take a step back, and it's the U.S. refinances percentage of total applications, how it's going up. And, you know, obviously nowhere near what it was back when we were getting these crazy rates. But my thing is, like, if you're sitting here refinancing right now, that means you're refinancing at some really high rates. So are you just desperate for money? Is it people are just really desperate for money? What I want to know, because somebody said, oh, people with a lot of equity in their home aren't desperate for money. That's ridiculous, by the way. No offense. But I mean, I don't know if you ever heard the term house poor. I'm sure the United States invented it. But I know folks in my own life that, you know, they are house poor. They're trying to make things look good, but their mortgage and all that stuff is such a large percentage of their budget. Oh, I mean, they're just barely making it. So if they lose their job, what have you seen? A lot of layoffs getting announced, right? You lose your job, you're hurting. And you're going to be one of the people refinancing. But let me know. Maybe there's other reason people are trying to refi into these higher rates. But the one thing to watch out for, I've been wanting to put this in here for a while, is what's going on with credit cards and stuff, right? And you can see credit card delinquencies, yeah. I mean, they're going up. I don't know why anybody's surprised. This is the 90-plus day delinquency. This is when it gets pretty bad. Once you get 90 days, you're kind of screwed, right? And so that's going up. But again, there's things that are keeping us afloat on this, as you can see, like student loans, things like that. But then when you break it down by credit cards, by the type of bank, whether it's a small bank or a large bank, you can see the small banks are like, ooh boy, they're way up there. 7.8. Okay, 7.8. This goes back in the 90s. 7.8. All right, so they're hurting on multiple fronts. Look at the large banks though. Nope. Right, they're kind of a little bit above what was normal from like 2010 and 2015, but not even close to like what it was in the 90s and early 2000s and stuff like that, right? And then there's another one that I just want to make you aware of, and it's these buy now, pay later programs. What I didn't realize was these programs don't report to the credit bureaus and stuff, and so we have no idea how much people are in debt in those things. And then this guy right here does a real quick snippet of what he believes is actually happening, and they call it like hidden debt or something.
Our next guest says credit racked up through buy now, pay later programs is hard to measure, and this, quote, phantom debt could eventually create trouble in the broader economy. Joining us right now is senior economist and managing director at Wells Fargo, Tim Quinlan. Good morning to you. You call it phantom debt. You say it's not really calculated in the total numbers. Tell us sort of how it is calculated and how worried we should or should not be.
Yeah, it's scary and you can't see it. What else do you call it? And it's tricky to kind of corral the data around it. A Federal Reserve paper lamented this in a long footnote saying how difficult it was to accumulate the data because firms understandably want to kind of protect the proprietary value of what they've got.
From your estimate/guesstimate, what are we dealing with, and what percentage of the credit market is this buy now, pay later business?
So it's kind of a tricky thing to think about, right? Because they're usually paid off in 4 or 6 equal payments. So the people in the space tend to think about it in the context of transaction volume rather than a traditional credit analysis that might look at it in the context of balances, for example. So what you can kind of do is look at the transaction volume in a given year and compare that to the growth in, say, revolving credit or consumer credit card debt. And if you do it by that measure, your kind of average growth rate for consumer credit card debt is round numbers, $125, $150 billion a year. Our back of the envelope estimates put the BNPL market at somewhere in the neighborhood of 50 billion. So you're talking comfortably a third of the transaction increase in credit card volume. If that's actually what it is, that's a really big piece of kind of this shadow credit market or phantom debt.
And so when we look at this list of like how much debt we're in, we don't even know about that. Let me know if you got any debt on that or how that's working. But the fact they don't report to the credit agencies, I mean, that's not good. So we have no idea, behind the scenes, like how many people are in debt to these companies and stuff. I don't know. Let me know if you're one of them. All right. So hopefully that gives you an update and stuff. As far as recession, I don't know how you fix the housing market without a recession. I don't know. But, again, I've talked about that one for a while. Let me know what you guys think about that. And we have 2 questions left, and one's very easy here. Does anybody know which website the calendar he shows comes from with the different colors? Yes, right here. If you look at this, it's called 4X Factory right there in the corner. You see it right there? And just click on calendar. All right, it's a really good use. It shows you the different colors, which one's red folder news. That's the one that kind of really moves the market, and then there's the other ones as well. And it don't mean just because it's not red folder it doesn't move it, but that's hopefully the website you can look for, 4xfactory.com. And now this one I need your help on. So hey Mike, first of all, thanks for what you do. I look forward to watching your video every trading day. This question is for Saturday's show. I asked you before, but can you please elaborate on how I can buy shares as soon as the pre-market opens at 4 a.m. Eastern time? If I am not a large volume trader. In a previous video, you advised the reason why I can't get my buy or sell build filled is because of low volume, but you also said there are ways around that, but didn't go into detail. Please let me know. And if any of you do this, I'm not up at 4 a.m. that's for sure, not even close to it. So I don't really deal too much in the pre-market stuff unless I'm doing futures. But if you do this, please can you put in the comments what's your secret to getting your order filled super, super early, all right? Between, I guess, 4 a.m. to 6 a.m., somewhere in that realm. And let me know, or if there's not a secret, let us know. But, let us know if you got any tricks of the trade. We really appreciate it. So hopefully we'll get that one answered for you. Again, if you have any more questions, feel free to put them in the comments. Try to answer them next Saturday. And I appreciate all you guys and all your help and your comments and watching the videos and giving thumbs up and all that good stuff. Okay, you are the best. This is always one of my favorite videos to do for the week for sure. So hope you guys end up having a good one. I'll see you tomorrow for a video, and then we'll set up the week for Monday. Don't forget markets closed on Monday. So have a good rest of your weekend, guys. See you later.